Hey everyone, welcome to episode 2 of SDR Finance's new podcast, Cash Chronicles.
Hello, everyone. My name is Ken,
And hi everyone, my name is Sarina.
and Ryan sends his well wishes.
So, today we'll be talking about a different issue in finance.
Budgeting.
Okay, great. So, Ken, what should I do when I want to get into budgeting?
I think the first thing you have to do is you have to look at what your current situation is right now. You got to identify what's your income. So identify all your sources of income, your salaries, your bonuses, any interests, dividends, capital gains, anything that involves money in, identify it. And secondly, you identify what your current expenses are. So fixed expenses such as rent, mortgages, utilities, insurance, loan payments, and then all your other expenses like, groceries, transportation, entertainment, dining out, clothing, all that fun stuff. If you want to improve your budget, you got to start with identifying, what is on the table right now. And generally speaking, the stuff that you can cut out is the variable expenses like groceries, dining out, and clothing, entertainment, and dining out. Those are all discretionary expenses. So most times when people want to start cutting things, they're gonna look at basically discretionary stuff, things that you don't need, and they're gonna find a way to cut it. That's always where you start.
Oh, damn it. Here I was considering whether I should spend $10,000 on that new game on the PS5 or spend it all on food and clothing. But here I am. How should I prepare for that? How should I make sure to set financial goals and like what are the possible financial goals I could set?
Here's the thing. In life, you always gotta save for something, whether that be, the next vacation, the next phone, or even retirement, right? It's important to save. Saving is very important. And I'm gonna break it down in three sections, if you will, three time frames. First of all, you're looking at short-term goals, right? Like vacations, big purchases, all that stuff, paying off debts. That's like a 0 to 1 year thing, right? Start saving there first. After you want to start taking care of your debts. Any debts that you can't pay off, like credit card debts, line of credit debts, that stuff paid off. Paying off your student loans, that's always a big one. If you are looking to buy a house, maybe saving some money for a down payment. That's basically like your major life goals, like, saving for your retirement. Maybe starting an RESP for your kids, that sort of stuff. That's how I'd break it down.
Yeah, all these things are of course super important, but I think all of these can be pretty much adjustable. For example, if you're someone who doesn't want to have kids, you can always adjust expenses as possible. And about housing, it's okay if you can't buy a house right now. Like, look at the situation of the Canadian housing market right now. It's not going great.
Uh, you know what? Here's the way I'll put it for you. When I was younger, my dad used to teach me the saving rules, which is that, when you're young, you if you have a part-time job or whatever,
And
right? You
you're
save. Yeah.
16. But what did when I was younger
When I
truly
was younger, okay,
mean?
when I was younger, let's just say like, when I was like, I don't know, like 10, 11, 12, something like that.
Uh,
And usually, okay, so basically in a nutshell, when you're young, when you're a teenager, right?
yeah.
For all your income that you get, you should be looking to, ideally speaking, spend 1/3, save 1/3, and invest 1/3 in stocks if you can. But if you can't, then saving 2/3, that's pretty nice. But
Yeah.
then as you get older, you have more responsibilities. You definitely cannot afford to, spend and save 2/3 of your income. It doesn't work like that. So in my view, if you can spend about 2/3 on all your expenses, housing, what have you not, and you can save about 30%, 40%, I think you're in pretty good shape. But also I think it's also very important to talk about the fact that I'm a strong believer in the fact that you only live life once. So it's important to save, yes, but not to a point where it greatly affects your enjoyment of life. It's important to treat yourself, is what I'm saying, right? Like, don't get me wrong, money's good, but after a certain point, not so much. It's important to enjoy and also to be disciplined at the same time.
Mhm.
And it's important for everyone to find that balance. I think that's so
Yeah.
important.
Yeah. Like there's only so much money you can have before you just die very rich and without that many meaningful life experiences. Of course, saving is important and should be perhaps your number one priority, but make number two priorities very important as well. If you have enough money to go on that vacation or to like buy that luxury bag or car that you've dreamed of, and you are financially stable enough to buy it, go for it. Life isn't all about saving. And that's why creating a budget is extremely important. You can track spending by using tools such as budgeting apps, Google Documents, Google Sheets, Excel, and you can also manually track expenses by keeping receipts and noting transitions. I think a good part of that is being able to create categories such as housing, food, transportation, entertainment, etc. Like Ken has said, it's always good to note your fixed expenses, to note your variable expenses, and truly have everything laid out for you in a way that you can understand. Oh, wait, maybe I shouldn't be spending $1,000 on, I don't know, alcohol when I have utilities to pay off. Furthermore, I think it's also important to have a written down budget because you're allowed to adjust any expenses as needed. Obviously, budgeting is something that's never going to be fixed. You don't know how much exactly on food you're going to spend on food the following month. You don't know how much exactly you're going to spend on utilities. So it's great to adjust your budget to take into account these things. For example, if my utilities go up by $200 because I have someone over for a month, then that's something I need to budget for. Maybe I can take money from elsewhere to put it back in.
I think the number one thing to make sure you know that if you find yourself taking on debt to cover things that are not like absolute needs, like if you're taking on debt to pay for like a vacation or an iPhone or something like that, you should not be taking on that debt in the first place. You do not spend money that you don't have. That's extremely important.
That's very true. Like, for example, if you want to save up for something, it's always better to make sure that you can cover the amount pretty much up to 75% of what you're going to pay no matter what. Like, if I wanted to buy, I don't know, one of Ken's new suits that he's wearing to school for some reason, and it costs like how much do your suits cost, Ken? Like, are they from your parents or something?
I mean, it depends. Like suits, like here's the thing. I never buy suits full price, but I think a reasonable cost for a suit, if
Huh?
you get it on a good sale, probably $250 all in.
Oh
250,
my.
300. Not cheap.
Okay, that could be worse. Like I've been considering like buying a blazer and stuff. Maybe I should splurge on something. But if I wanted to buy, for example, a blazer that costs around $250, I would make sure that I have at least around 200 of that money on hand so I can pay it off and maybe at most take a fifth of it or perhaps even like a fourth of it on credit at most. Always, it's better
Yeah, it's
for you to pay something
crazy.
off. Yeah, I know. Clothing's gotten so
Everything's so expensive these days. Like I was trying
yeah,
to go for a
exactly.
Coldplay concert.
Yeah.
Yeah, I was trying to go for a Coldplay concert this afternoon, right? And I was on the Ticketmaster website.
Oh
Oh
my,
my God, by the time I was like I think 12,000 in line pretty much. And by the time I was there,
12,000? Oh
12
my
oh no,
God.
that's not even my friend got like 57,000. It's insane. I'm telling you. Insane. So
Wow.
12,000. I was for Coldplay, mind you.
Cold.
12,000. Coldplay.
I
It's not even Taylor
know.
Swift, it's Coldplay. I was there
I know. I
on
was
the
like,
pre-sale. And
yeah,
the tickets are and by the time I was there, everything was sold out. The only thing that was there was the VIP tickets. It's like 700 bucks.
$12,000. That's
No,
it.
no, no, no. My queue was 12,000. The tickets
Oh,
itself, the tickets itself, I think the VIP tickets were probably like 700, 800 bucks, but the
okay.
fee,
That's
Ticketmaster
not
charges,
better, Ken.
it's crazy. And
I know.
Ticketmaster charges like 100 bucks. The fees for that ticket was like 100 bucks,
Oh my
70,
days.
80 bucks, whatever it was. It's insane. It's a monopoly.
I know. Like I
Insane.
heard something about like Ticketmaster's monopoly being judged in the
Oh
U.S.
no,
Supreme
Ticketmaster. Like here, fact of the matter is, in Canada, in the US, and to an even greater extent, Canada, we have a serious competition issue. Like a lot of the major sectors, banking, telecommunication, aviation, groceries, it's all
Did you hear about,
oligopolies,
yeah,
no
did you hear
competition.
about like Nortel, the telecommunications monopoly? It's pretty
Yeah,
interesting. I think that might be a topic better suited to a separate like podcast episode
that's
about
another day.
cost of
That is
living.
another day.
So back on
Yep,
topic.
yep.
In case you ever want to pay a lot of money or you're in an accident and you're unable to truly get a steady source of income, we would both suggest building an emergency fund.
Like I was saying earlier, you want to make sure that that emergency fund is ideally speaking about 3 to 6 months worth of your expenses, right? And by expenses, we mean like, it's like bare minimum stuff, like, food, rent, utilities, transportation, all that stuff should be factored in your emergency fund. And you do not, and by the way, you want this money to be liquid, meaning that it should be in cash. It should not be in things like, stocks, bonds, anything like that. So our suggestion is find a high interest savings account or a money market account and just put the money in there, They'll probably like right now that high interest account should probably be about 3 or 4% interest. And it's not bad. It's a very risk-free way to grow your money for the time being. Just keep it there and hope you never need it. And if you do need it, well then it's there for you.
Yeah, that's so true. Okay, furthermore, if you want to build the fund, but if saving 3 to 6 months worth of expenses seems daunting, start with smaller milestones like $1,000 or even 1 month's expenses. $200 doesn't seem like a lot of money to have in a situation, considering the prices of blazers and the general cost of living crisis Canada is going through. But $200 can really save you in a pinch if you have, for example, an unexpected flat on your car or you need to buy a $200 blazer for whatever reason.
But
That's,
hey, you know what? It's better to have $200 than to have $0.
yeah,
Always remember
exactly.
that. It's better to have something than nothing. So if you can
Yeah,
save, save. This is why we save.
this is why we save indeed. Furthermore, if you ever have trouble having making the commitment of transferring money from your banking account to your emergency fund, you can set up automatic transfers from your checking to your emergency fund to ensure constant contributions. So if you forget 1 month, then it's not the end of the world because you didn't actually forget.
And hey, that goes for everything, not just emergency savings, things like an RBSP for your kids' education, your tax-free savings account, your retirement savings. It can all be automated with and it's called a continuous savings plan. It's an automated transfer of money from one account to another. All banks offer it, and it should be free.
Okay, that's very true. Of course, if you want to pay back any sort of debt that you have right now, you should focus on high interest debt first. For example, credit card debt to minimize interest payments. It's pretty self-explanatory. If I have a pile of money that I need to pay that's growing exponentially and a pile of money that's growing linearly that I also have to pay, perhaps it's better to pay off the exponentially growing pile of debt so I don't have to deal with that later on. So
I was also
yeah.
reading, Sarina.
Yeah.
Okay, this is the funny thing. I was at the bank the other day, right? And they were so okay. I was getting to do some withdrawal of money, and then the teller, she was like, "Mr. Lee, thank you for being a longtime customer of the bank. I can see that you have a lot of stuff with us. Would you like a credit card? We have 0% interest on balance transfers for 12 months." And it's funny that you mention it because that is exactly what that sort of stuff is. If you can get a credit card approved, a lot of credit cards usually come with like a 12-month balance transfer. You just pay a small 1-2% fee, and then you transfer your balance in up to your credit limit, and it's free, interest free for 12 months. That is a huge, huge lifeline if you have credit card debt because as we all know, how much is credit card? How much is the interest on credit card? It's like what, 21, 22, 23%?
That's insane. Like,
No, it's so predatory. My
yeah,
goodness.
like if I wanted to buy what a calf cookie, or perhaps to make it more easier to visualize 5 calf cookies, then the amount of credit card debt I would have if I were using a credit card would be enough for me to buy a full other cookie, which is probably says more about how expensive St. Robert's cookies are, but we do what we have to.
I gotta ask, they shrunk the cookies, didn't they? I swear
I
they were bigger
did.
last year.
I
It was
swear they
bigger
were.
last year.
Yeah.
Ever since they changed the company, I swear to God, everything's like I was talking to someone, right? They bought a bowl of noodles, six
Oh,
dollars, six, $7
six
for like
dollars.
for plain noodles and one piece of broccoli. Like, come on,
Wow.
really?
Come on. You gotta change St. Robert's. We have enough issues at our school already. We can't have a cafeteria falling again to predatory management. But
No,
anyway,
no, we can't.
speaking of predatory management and debt repayment strategies, there are two main ways to pay off debt. First of all is the snowball method, in which you pay off the smallest debt first while making minimum payments on larger debts. And once the smallest debt is paid off, you can move on to the next smallest. This is particularly good if you're feeling demotivated by a large amount of debt spread over various places because it gives you a sense of accomplishment. And besides, like even small steps are still steps going in the right direction. Secondly, I think he didn't have the avalanche method. So, Ken, what do you think
So, sorry,
about
could you
that?
repeat that? You just cut out on my line a second. What did you say?
Oh yeah, my bad. So I think there's another type of debt pay repayment strategy that seems quite
Yes,
interesting.
called the avalanche method. And basically, it is what I was kind of alluding to earlier, which is paying off the debt with the highest interest rate first, and then making minimum payments on others, which would, in the long run, save you more money on interest. But like I also alluded to earlier, if you can, if you can, what's the word? To put,
Yeah,
if you, to not, I'm saying, like, I'm looking for a word that's like basically like, to, yes, consolidate. If you can consolidate your debt into one big debt with a lower interest rate overall, it would be the most ideal solution here. Would be.
it would be because you would manage to somewhat avoid any predatory finances slash any predatory loan repayment structures like charging 21% interest as a
Oh,
whole.
but you know what? That's not
What?
even the worst part. You know those companies like, Easy Financial and
Yeah. Oh,
those
like
companies?
payday loans?
Yeah, payday loans. Like some of those companies like Easy Financial, they offer you personal loans. The interest rate can be as high as like, if I remember reading like 2, 3 years ago, as high as 50%. It's very possible.
Oh,
If you like here, look at it this way. If your bank doesn't approve you for a credit card or a loan, there's a reason why. You have to look and you have to find out why that reason is. But the point I'm getting here is that um these companies, these payday companies, they're basically a bank of last resort for the people that cannot find approval, that cannot find traditional, financing through a bank. They go to these places.
Mhm.
And hey, I think it speaks for itself. 50% interest. That is predatory, and I'm pretty sure that's close to illegal.
Yeah,
There is an illegal interest in Canada. I think it's like 60%. It's insane. It is insane.
it is. If you like these places, of course, we aren't shaming anyone who needs to use these places, but if you have the choice and if you're just looking for some quick money, don't go to these places. You are worth more than that. You'll be paying off these loans for perhaps a very long time. You should instead budget for any extra payments. Any additional money, such as, for example, bonuses or tax refunds, should be directed towards either your savings account or debt repayment. Tax refunds might seem like a gift for you because it's basically the government saying, oopsies, we made a mistake. Here's your money back. And you might be tempted to write it off as basically a gift or a present of sorts.
That's girl math right there, by the way.
That's just insane. But anyway, I think there's another way that you can invest your money, which is, I think, saving and investing it.
Yes, and like I was saying just a second earlier, you as part if you get any money from working your job or whatever, you should start to look towards your retirement savings. And here's the way I'll put it. You basically have a few options when it comes to retirement savings. You have so it depends on what company you go with, but a lot of companies, if you're a full-time employee, or even part-time employees, in some circumstances, they will usually offer, as part of your benefits package, some sort of retirement savings plan. And the most common one these days is usually something called defined contribution pension plan. And that's basically when you open up an RRSP, registered retirement savings plan, and every dollar, every like a percent of every dollar that you invest will be matched by your employer up to certain up to a certain amount. Like let's say for example, I don't know, your employer will match if you put in 9% of your income, your employer will match let's say 4.5% of your income. They'll match that. They'll match every dollar that you put in up to certain predefined limits. And the second option is usually something called a defined benefit plan, and that's basically a traditional pension plan. For every year of service that you work, there is a formula for every year of service that you work times a certain percentage. That's your benefit. And the way that works is that the risk of the investing that's on your employer. So let's say you worked 40 years, right? And your company pays you, let's say, 2% for each year you work. When you retire, you get paid 80% of your income. 40 years times 2%, 80% of your income. And that's a guaranteed source of income for life. And after you pass away, your spouse, they also get a survivor's benefit up until you're gone too.
Hmm. That sounds very good for any people who are struggling with finances, who might consider themselves to be in a position where they might struggle with finances later on in life. But anyways, there are also lots of other ways to make sure that you get the most out of your money. such as various investment options like stocks, which we talked about in the previous episode of SCR Finance, bonds, and mutual funds slash mutual funds slash ETFs. So there are many examples of mutual funds. I don't think I can think of one right now, but Ken might be able to.
That's for another time, my friend. That's
And
for another time.
for another time indeed. But these are all efficient ways to save money for the future and to invest in your future. Okay, so I guess finally, what you can do to make sure that you're sticking to the budget that you set for yourself is making sure to review your goals. You can do this by having regular check-ins with your budget. You check your budget and spending monthly to make sure that you're on track. Your goal is to review your financial goals and progress every 3 to 6 months. And by that way, you can adjust your budgets and strategies based on changes in income, expenses, or goals. For example, if I am quitting a job or I've started a new position at my current company, then I can adjust my budget to have perhaps a little more in expenses, savings, and any financial aspects of my life that I feel like could use an increase with. Furthermore, it's important to know that goals can be adjusted. So what are some examples of goals can be adjusted? Because I know for sure that my academic goals are not changed anytime soon.
Hey, don't worry, that's why we have conversions. So yeah,
Yeah.
every time that you have, major life changes, like, you change jobs, you have children, you move in with your partner, you get married, what have you not, it's important to update your budget and also your financial goals, right? And you know what? This is what I'm gonna say. And if there's one thing I can say, let it be this. Goals, goals are subject to change, obviously, but it's important, and let this be the main takeaway, to set manageable, small goals that you can make steps towards. It's a lot easier psychologically to accomplish a small goal rather than to accomplish a huge goal. Break your goals into manageable chunks and work towards the chunks. Work towards those chunks instead of working towards the main picture. You'll get there in the end. Don't worry.
That's very true. No matter how little progress you seem to be making so far, progress is still progress, and that's the most important thing. As long as you're moving, you are getting somewhere, preferably to a destination that you want to be at. So therefore, consider when you get a raise or bonus, consider increasing your savings or investing rather than increasing your spending. So what does this look like? This looks like me investing more into perhaps a retirement fund or my university fund in particular, rather than going out and buying 200 cap cookies. But anyway, I think that is it for today.
So yeah, so basically, just to summarize everything we've gone over, set a budget, make those small goals and work towards your goals, and just a bit of just use common sense. You got to ask yourself when you're buying something, is this a need or is this a want? And if it's a want, then you really got to justify it and be like, hey, how does this want affect my future, my goals, first of all, my budget, and is there any way that you can put off this want? But then again, on that hand, it's important to balance budgeting and also have a bit of fun in life. And where you find that balance, where you find that, is ultimately up to you. So yeah, that's basically it. Come join us next time.
Yep. So thank you everyone for listening. This is Sarina
And this is Ken.
and Ryan's in the background. And thank you all for tuning in to another episode of the Cash Chronicles. Bye, everyone.